Welcome to another episode of Selling Life and Annuities. I'm your host, Ray Parman, Life Insurance Sales Manager here at Gordon Marketing, and today I have my phenomenal friend here, Paul Bechtold, who's our RVP and Debt Elimination Manager. Paul, so we're going to talk about yet another savvy sales idea that I think people need to know more about, and it's creating a non-MEC policy with only 2 premium payments. So, Paul, can you expound on what that looks like for everybody out there tuning in?
Yeah, sure. I would love to, Ray, because I was taught this concept by a very smart gentleman a few years ago, and very few agents know that it exists. So most agents are familiar with short pay cycle policies, a 5-pay, a 7-pay, even single premium. So let's start first and talk about, the shortest one, which is the single premium. But the problem with a single premium is it's a MEC policy, right? We shove a bunch of cash in all at once. We're not funding again in the future. So it automatically creates a MEC, which means that any gain above the cost basis paid in is taxed at ordinary income rate. So what I like to say is that the single premium MEC policy is like the life insurance version of a qualified annuity or non-qualified annuity.
Non-qualified.
Yep. Yeah. Okay. Where we're entering taxation above the cost basis. Now, obviously, the big advantage of then going to what I would say is the next step would be the 2-pay non-MEC, is that being a non-MEC policy, we're avoiding taxation.
Oh, yeah.
Okay, so we're growing tax deferred. We're taking loans out. Those are all tax-free because it's abiding by the guideline premium test, the IRS rules for that. And the way we do that, Ray, is let's just use an example. So if let's say I found a wealthy client, they have $500,000 sitting somewhere that they wanted to put in as a single premium. Okay, they do a one-time dump in of $500,000. Now the advantage of that versus an annuity is that the estate through the death benefit is multiplied X time more.
Yeah,
right?
Get some serious leverage on that.
So if that person died the next day, instead of $500,000 to their beneficiaries, in this case you have a 50-year-old would have $899,000.
Tax-free nonetheless, right?
Tax-free, right?
Yeah.
On death benefits, always tax-free regardless of the fact that it's a MEC policy. Okay. Now, that same client comes to me and says, well, I'd really love this concept of putting money in a life insurance policy, but how could you do it and avoid the taxation? Well, I could do 250 in the first 2 years, okay? Now, instead of a starting death benefit of $899,000, they got a $3 million death benefit. Much better, right?
Yeah.
Okay.
Golly,
and now what I'm going to do is I'm going to borrow from the policy cash values that I have to pay the next 5 years of the policy, because it has to abide by what we call the 7-pay guideline premium test, right? And so I have to have funding going in there for 7 straight years, but I'm going to do that by borrowing from the policy cash values.
Yep.
Now, there's some additional benefits here, Ray, that I really want to expand upon.
What do those look like?
Okay. So I just had a client last week. I actually helped an agent close a case with a 2-pay non-MEC, okay? But what she liked about it, now she wasn't doing 250, but she was doing 50,000 a year. Okay. But she liked the idea that in the subsequent years 3, 4, 5, 6, and 7, that she might have enough money of her own to put in the policy instead of borrowing from the policy cash values to fund it.
Oh, yeah. See, that's nice. That's real nice. They give some flexibility.
Yeah, good flexibility. Allows us to grow our cash value more. Allows us to increase that death benefit, right? And it gives us options in the future because, everything's great on a snapshot today, but we don't know what tomorrow brings, right?
That is true.
Might lose our job, and we may come into an inheritance. We may have things happen better or worse in our life that will dictate where that money is going to come from to fund the policy. But what we know is, worst case, we go with 2 payments, we borrow from the policy cash values, and then in the 8th year, we go to a reduced paid-up policy that we're never going to put anything into.
Yeah. I can't help but notice the cash value retention, too, in the first couple of years is pretty darn nice, too.
It's very, very nice. And the idea of getting as much in early in those policies, whether it's the single premium or the 2-pay non-MEC, it's a high degree of efficiency in terms of cash performance. Usually, some 85 to 90% of the money that we put in premium is available in cash value.
Yeah. Okay.
So really, really, really nice.
Yeah. So what kind of clients would you say kind of fit this profile? Like who should agents be looking for? within maybe their own client base or new prospective clients that they're meeting with to maybe introduce a concept like that too?
Well, I think the best place to start would be like small business owners that are high cash cow kind of businesses.
Oh, yeah.
Maybe somebody that owns a chain of restaurants. Maybe somebody that's a real estate investor. Somebody like that where there's ebbs and flows of large amounts of money. Yeah. And if they play with just a little bit of planning, they could have the money available to put in. But then again, if they needed to get that money back out to borrow it to go buy another home or go do something, they got the money available to do that. So probably one of the most popular targeted concepts or clients for this would be real estate investors.
Oh yeah, yeah, and I get questions about this all the time too, and so many agents they say, hey, I just want to do a single pay, and yeah, technically we can make that happen, but oftentimes it's all about that cash value growth too, and wanting to use that for strategic ventures if you're a business owner. And a two-pay, yes, you can still get that money in short order, but you're not going to MEC that policy. That kind of defeats the purpose of doing that in the first place, too, right?
Right, exactly. But let's take a look at something that is very near and dear to the agent's heart.
Yes.
Okay.
What would that be?
And let's look at what the commission difference would be.
Yeah.
Okay.
Do tell.
Okay.
Do tell.
Okay. So we mentioned the idea of annuity, right? So let's enter that in. Let's compare an annuity to a single premium life insurance to a two-pay non-MEC.
Yeah.
Okay.
Yeah.
So the easiest one right off the bat is let's just say that we had $500,000 going in an annuity. That'd be between $30,000 and $35,000 depending on the commission level.
Yeah.
That agent would earn on an annuity. Okay. Now, single premium life insurance would be a little bit less than that. And the example of this one would be about $23,500. Okay?
Still not a bad day.
It still isn't. But what I really challenge you annuity producers out there watching this is this, okay? Take a step of faith out there and look at the single premium life and the two-pay non-MEC as an option, because the additional death benefit and what you're doing for your client is so much stronger, and especially in the two-pay, the avoidance of taxation is huge.
Oh,
okay?
yeah.
But let's just say they did take that leap of faith, Ray, and they came to us with this concept for the two-pay non-MEC.
So we're doing $250 in year one and $250 going into year two.
Right. Instead of the $500 maybe going into an annuity or a single premium. Now they would earn $44,250.
Ooh. In the first year, right?
In the first year. And what do life insurance have that annuities don't have?
Renewals?
That is correct, Ray. I like that. So you're on your game today.
Oh, yeah, I'm sharp, man. So here's a chance to make, even more commission, and then, not only a big pop in the first year, but then for the next years 2 through 10, in most cases, even more renewal commission coming in.
Up to 20 years in some cases.
Okay.
I mean, for that kind of premium going in.
Yeah, not too shabby.
Not too shabby. That's what we call mailbox money, right,
yeah,
Ray?
Yeah, we love that.
Okay.
Yes.
So, Ray, if agents want to know more, all they got to do is call me, 317-626-3054. Contact me at paul@gordonmarketing.com. This is really not a difficult concept, folks. Or if you're a prospective client out there and you want to know more, call me as well. But, I mean, sounds complicated, really is not.
Yeah.
I can put an illustration together, get it in your hands, but especially if you're an annuity producer out there looking at what is going to be in the client's best interest, an annuity, a single premium, a two-pay non-MEC. I did this recently for our annuity marketer, Steve Allison. I showed him how to take a client and do that. And he was really, really piqued by that and really interested. But it's a tool you need in your toolbox. Don't hesitate to reach out. Ray, any final thoughts?
Yeah, there's all sorts of fun we can have with this, and not to forget, a lot of these carriers actually they have living benefits too, so chronic and critical illness. So if you did get sick along the way, the death benefit could be redirected to help pay for claims or expenses that come up with that too. So Paul, as you say all the time, I mean, cash value life insurance, it truly is that financial Swiss Army knife, and so. Again, just some sage advice, great ideas. Certainly appreciate you sharing with us today. But for now, I'm going to go ahead and close things down, put a bow on this episode of Selling Life and Annuities. But before I let you go, don't forget to hit like and subscribe. Share these videos with your friends, your colleagues, your clients. And next time you have a case, come give us a call. But for now, we're going to end this one. And Paul,
Happy selling.
see you in the next one.